Well, Canada's economy started the year in 2023 definitely on the front foot. The economy expanded in January by 0.5%. And in fact, that momentum continued in February. So we didn't see signs of a slowdown or a give back. That's according to the flash estimate. So that certainly could be revised, but certainly suggests that the economy is on pace for a broader expansion than even the Bank of Canada's own forecast. For a look at what this means, we've got Jimmy Jean. He's the chief economist and strategist at Desjardins. Jimmy, thanks so much for being with us. What was your initial take of the strength that we saw and what was underpinning it?
Well, first of all, it's broad-based. It's broad-based across goods, across sectors, like services. And we also see some strength in some sectors that are at the forefront of the housing slowdown, such as construction. The other thing is, as you mentioned, that preliminary indication for a 0.3% advance in February could be revised. But if it does pan out, we could end up with GDP rising 3% in Q1, which is above potential GDP. So that's not good news in an economy that's been overheating, and that we do need to see cool off in a more broad, decisive, and sustained way than what we've seen so far.
Not good news because it filters into inflation.
Well, right. And we've seen how the Bank of Canada is approaching the recent events. There was a question, of course, given the banking turmoil as to whether that would lead the Bank of Canada to drop its hawkish leaning forward guidance. And we really did get the answer this week with Deputy Governor Gravel's speech. He's still more concerned about those overheating signals and that pressure on inflation, especially core inflation, than he is about the downside economic downside risk. I think there's a couple of things, though, to keep in mind. First, if this ends up in a tightening of credit, but in a more contained way than what we've seen during March, that actually plays exactly into the Bank of Canada's inflation objective. So they wouldn't go and try to offset this now. And then the second point is that we have to recall that the bank is looking for signs that monetary policy is sufficiently restrictive to maintain that pause. And remember, the battle is really going to be in services inflation, excluding shelter. And it's really hard to see how you bring this inflation down without a meaningful slowdown in consumer spending in particular. So I think it's fair to say the evidence is not yet compelling enough. We know the ingredients are there, but they need to see results.
So right now, when you look at what the market is pricing in, it's still an expectation that we get rate cuts. What's your view, and is the risk, how big is the risk that after the pause comes rate hikes, not rate cuts?
I think it's a risk that markets need to appreciate a little bit better. Not to say that it's our baseline view. We do think the next move will be a cut, but it's likely to come towards the end of the year. But the Bank of Canada's statement clearly mentions that if the conditions are not showing a sufficient level of restriction, they're ready to hike rates again. And they do have different tools that they're ready to use to address bank funding problems or financial system issues in general. And that's what Deputy Governor Gravel spoke about this week. So I think this idea of seeing rate cuts is still the market pricing in a tail risk event rather than something reasonable as a baseline.
I think about one of the other major events this week, which was the federal budget. And a lot of the criticism was, no path to balanced books at a time where you're seeing deteriorating economic fundamentals, except we're not seeing deteriorating economic fundamentals. Could that resiliency perhaps mean that Canada's own balance sheet ends up in better shape?
For sure, and there's always, they provide downside risk, but there are also some upside risks to any budget projection. But I think we need to keep in mind that there's still a lot of pressure out there coming from the impact of last year's tightening, also the tighter lending activity that we're likely to see going forward. And really, this is the lifeblood of an economy. So I do think that even if the timing is not very easy to get precise, we will see a meaningful slowdown going forward. So really, that's the risk that this budget needed to prepare for. It's really showing bigger deficits as a result, but at the same time, as as was abundantly mentioned, lots of spending. Part of it is structural in nature, but it does put public finances on a slightly more fragile footing than what we had in the past.
I'm just curious, where do you go for information about understanding if financial conditions are getting tighter or looser? I know in the U.S. there's this financial conditions index. Is it as clear in Canada? Is it through data that the BOC puts out, or watching the bank's own lending activity? Is it possible to get a clear picture of what that looks like in the country?
Right. Those financial conditions index are, they're deeply flawed. They're not. They capture really market sentiment, and really in current circumstances, what we really want to get at is how lending is flowing. What are the financial conditions index for Main Street, not Wall Street, nor not Bay Street? And for that, we're going to have to look at surveys such as the Senior Loan Officer Survey by the Bank of Canada. My hope is that they increase the frequency of those releases, that we can get access to very timely information, because this is really going to be important, including for them to know whether we are seeing perhaps even more credit retrenchment than expected. That would have them more confident that the effects of monetary policy are working, because this is what it's speaking to, is the lagged effects producing more force than what was previously anticipated.
Jimmy.